Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Alrighty, happy Wednesday. How is everybody doing out there today? Hope you are doing well. My name is Andrew Kuhn, sitting alongside my co-founder, Mr. Geoffrey Gannon. He's back with us this week. Jeff, how are you doing over there?
I'm doing great, Andrew. How are you doing?
Did you enjoy your week vacation?
Yeah.
You didn't get to see my face, right? You're good. So thank you. I'm doing great. You didn't even ask me, but I'm doing great.
I think I asked you.
Did you ask me?
Well,
Okay.
they'll know.
All right. Well, we hope everyone's having a great week. We hope that you enjoyed last week's podcast with Ian Castle. Thank you so much to him again for coming on. Ian is awesome, and I greatly enjoyed that conversation and hope that you guys did too. Before we roll into today's podcast, just a little housekeeping. If you do want to follow us on Twitter, feel free to follow me at Focused Compound. We are going to be referencing some stuff from Twitter. I post tons of investing content that a lot of people seem to like, and then every now and then I'll post like Q&As, call for questions pretty much, and that's where we are going to be going over here today, because I did a call for questions and we got a lot of questions to go over. Okay. So are you ready for it?
Yep.
So if you want to be a part of that in the future, be on the lookout for it. That's at Focused Compound on Twitter. And if you do want to follow Jeff's weekly memo that he does send out, go to Focus Compounding, and on the homepage you'll see a spot to enter in your email, and that will put you on that list for a Monday morning memo from Jeff on investing principle. So we're going to be going over the questions right now.
Okay.
First question: do you invest in cyclical stocks? Under what circumstances?
That's a really good question. Generally, no. Not very cyclical stocks. I have had success investing in some cyclical stocks that are like cyclically tied to the financial cycle or advertising cycles, things like that, where the stock responds more than the business. But when they're talking about things like materials, so like mining stocks, oil stocks, things like that, usually not. I did talk a little bit about KLX Energy Services, which is a spinoff of KLXI, and that's a very cyclical stock, potentially, but that would be the sort of thing that we would look at.
Yeah, but you don't ever like not invest in a company because it's cyclical, right? Is that actually a thought in your mind, or?
Yeah, in general, to be honest, over very long periods of time, like if you look at industries over a century or something, less cyclical industries will outperform more cyclical industries. The reason is because of what a cycle is. So a cycle to happen isn't just some like mystical thing. It happens because of miscalculations by the companies involved in the industry. So it's usually some sort of group action where they're trying to better themselves individually, the firms, and so inadvertently cause something that hurts the whole industry. So they have too much capacity or something like that, right?
Sure.
So you have like the home building cycle or something similar to that. If you look at a list of the best performing industries over time, usually they are very not cyclical industries. An example of like one of the most cyclical industries I could think of would be shipbuilding. So when I say one of the most cyclical, I mean one of the longest cycles.
Okay.
So like semiconductors is very cyclical, but has a very short cycle.
Are you talking about like cruise ship builders or like what?
Any type of very big ship.
Got it. Okay.
So because the demand, here's the thing, the demand is if you've been operating a ship for 20 years, you could make it 22, 23 years.
Sure. Yeah.
So if there's bad economic times or something, that's what you do.
Yeah.
So then you don't put in new orders for the ships, and then you have a shipyard that isn't full of new orders. You have all those problems that happen. So it's a very, very long cycle. I can't think of an industry with a longer cycle than shipbuilding, although things like how long it takes to get a mine going and stuff is a long time too. But I would probably say that shipbuilding is one of the longest. And then you have really short cycle things like semiconductors, and you see that a lot with those sorts of stocks. Most of the stock questions I get about specific stocks where someone's really excited about it, who's a really smart person and a value investor, and I'm a little cautious for them to about the stock, is usually a cyclical, to be honest.
Really?
It really attracts value investors because it has a low P or low EV/EBITDA.
Sure. Yeah, that's how it always shows up on screeners. Yeah.
When I talked about KLX that's a stock that the only reason for being interested in is it was spun off without debt. Now it has debt because it just did an acquisition.
Yeah.
But it's a part of the cycle that's getting better. It's not at the peak of the cycle, right? So it was spun off not long after, a couple years after there had been a really bad part of the cycle. In fact, the company's history as a part of KLXI is basically is a bad part of the cycle. It's never operated in a really good part of the cycle. So that's the interesting part about it. Yeah,
sure, cool. I think that was a great answer. How do you think the portfolio of a family office should allocate? Very long-term horizon.
I've said this before, but I think they should allocate to something that has returns that is similar to stocks, but are not actually stocks.
Have you looked at before? I don't know if it's Yale. It's one of the big endowments, and the way that they structure their portfolio is not like a typical, like they own like a bunch of different stuff. I think they even own like timber and like just their portfolio is just crazy.
Right. Well, like for instance, I've said, I think that if you have a really, really long term, we're talking like I think I gave the example of like an endowment or something.
Yeah.
I would totally replace the typical bond portfolio part of it with timber. Yeah.
Really?
Timberland. Yeah.
Is that because where rates are today?
Because the returns are better over long periods of time. Like I just said about, what are returns over 100 years or something. I don't think you generally want to invest. My general feeling, how do I put this? I suggest investing if you have a really long-term horizon, I suggest investing in whatever asset classes and assets in general perform the best over very long periods of time, provided they aren't expensive when you buy them. So I would just avoid clearly overpaying for anything. So the first thing I would do is, can you allocate as much as possible to common stocks? Because common stocks perform the best, and high quality businesses in common stocks. But they're often expensive. And so if they're more expensive than usual, don't buy them. And then look for the next thing and the next thing, and it can be things. I mean, I talked a little bit about Timberland. We might talk about it later because I know that people have asked questions about some stocks that have that people are interested in that for whatever reason. I guess I talk about Timberland more than most people do, but it can also be commercial real estate. It can also be farmland, which I know nothing about, but those sorts of things have long-term returns that are as good or better than bonds, and yet aren't exactly correlated with common stocks. So there's things that could be in the portfolio. Yeah, I definitely think so.
It's interesting because I just pulled up on my phone the Yale asset allocation for 2019. It says 26% absolute return, 18% venture capital, 15.5% foreign equity, 15% leveraged buyouts, 9.5% real estate, 6.5% bonds and cash, 6.5% natural resources, and then only 3% domestic equities.
Oh, wow.
That's pretty, isn't that surprising?
That is very surprising, yeah. Yeah, I wouldn't do that.
Yeah.
I mean, I think domestic equities,
but the returns have been, like, I'm pretty sure, very good, too. Let's see. Yale's 20-year asset allocation class performance remains strong. Domestic equities return 11.8%, besting the benchmark by 4.9% annually. I don't know, but I'm really surprised to see that it only makes up 3% of their portfolio.
Yeah. So, I mean, I guess my general suggestion would be, if you have a really long-term horizon, don't hold a lot of cash, not bonds, higher quality assets. And so, for instance, some people own gold and things like that. Yeah. And I would say timberland's a better investment, or farmland, or occupied commercial real estate is a better investment than gold, because those things over the very long term have a relationship with inflation, so protection from it.
Yep.
And common stocks do to some extent. But are things that earn a return on their own over time. They generate it. And so just the highest quality assets you can find. So the highest quality businesses you can find. So that, for me, I would say the highest industry groups. So one of the first things I would do is look at what industries would I like for the really long term. So say you like, and by that I just mean that they're monopoly type businesses, high quality type businesses, things like that. I think I talked before about how, like, over the last 100 years or something, tobacco done really well, right?
Yeah.
And then something like coal or shipbuilding or something hasn't done well. Well, you're looking at the future, things like if you can find things like online media, things like if you say you like Facebook and Google, and Alphabet and things like that, well, then you would want to buy that would be on your sort of top of your list, but then don't buy them when they're expensive. So try to buy the best industries. Like I've talked about how I like certain industries, regional banks, MROs, things like that. Industries with a little less competition, especially less cyclical industries. So high quality, high returns on equity and stuff, but do not buy them when they're trading above the levels they've on average traded at.
But that's the way that you've always looked at it. You just say, like, you don't really make like I don't think you get too complex in it. You just say, where are we at in the cycle? If 5 years, are we going to be higher than we are today or lower? Like when you made your when you invested in Frost, that
Right.
was sort of your thought process that went into that.
Right.
Yeah.
So I like regional banks, but I wanted to wait for an opportunity to buy it when I thought it was cheaper than normal.
Yeah.
And I wouldn't say that for like
You get to like the extreme points.
right.
Yeah.
And if you have a very long term horizon, I don't think it you have to be cheap. But the one thing you have to avoid is not buying it when it's especially expensive. So don't buy into bubbles and things. You just have to avoid that. Otherwise, you can just buy high quality, predictable companies.
Yeah.
Yeah. Exactly.
Cool. I like this question. If your favorite uncle, do you have a favorite uncle? Do you have a favorite uncle?
I'm sure. Yeah.
Okay. If your favorite uncle left you $100,000 in his will under the condition that you have to buy one stock and hold it for 30 years, what would that stock be? I think that actually got the most favorites. A lot of people were interested in that one.
Wow.
I thought that was a pretty good question.
That's a very hard question. Yeah, that's a really good question. So you have to buy it and you have to hold it for 30 years.
My question to you is, would you buy a company that's more like a holding company, like a Berkshire Hathaway?
Yeah, that's
or
a way
would
of
it be
cheating,
more...
obviously, yeah.
Because, okay, but take Warren out of it. I'm saying any company that's sort of structured like that, where they own multiple different businesses. So you kind of have that diversification in that regard.
Right. Mm-hmm.
Instead of, betting on one company, like he said, where it could potentially be like, yes or no. I mean, it's like
Right.
Charlie Munger during the Daily Journal meeting that I went to, I think 2017, maybe 2016.
Okay.
He was talking about diversification, how the Mungers own 3 different assets, I guess he said.
Right.
Majority of the net worth. Berkshire Hathaway, Costco, and Lie Lose Fund.
Okay.
And it's true, Berkshire Hathaway, I understand the point that he was making about concentration. And he was saying that he thinks that they're well diversified. That's probably true, but I mean, Berkshire Hathaway is a very diversified business itself because they own so many different businesses.
Absolutely, yeah.
So do you think you would buy a company like that, more of a holding company, or?
Maybe Berkshire's involved in insurance, though, and what happens, over 30 years or something, could it blow up? That's a concern.
Yeah, sure.
I mean, we're talking about way after Buffett's there and things like that.
Yeah.
I don't know if I would buy a financial company because you do have that concern if you have to buy and hold it forever.
Yeah.
There are concerns like that. There's some, I know the company I said had the widest moat that I've ever seen is BWX Technologies, but it's involved in nuclear. There's a very small risk of some sort of nuclear event, but the liability from that is very high.
What about like a bank that's been around for a very long time?
Yeah, that's a possibility, but if it gets the wrong management in there for a long time, you have a problem.
Yeah.
If it was going to be a retailer, it would be Costco, but I wouldn't make it a retailer, so we can
Yeah,
eliminate
because
that from- the obvious one is something that has mind share, something that the sorts of things that immediately come to mind would be like the one that does immediately come to mind is Disney. Right, so that's
Really?
the first thing that comes to mind.
Just because it's been around
something-
for so long, it's kind of proven
What
the
its
test of
assets
time.
are things that and that can be reallocated over time. There you kind of can find what businesses have had really good success for a really long time. So some businesses that tend to be very have a very high chance of surviving for a really long time are anything that publishes some sort of intangible thing. So music publishing, game publishing, movie distribution, which is basically movie
Why?
publishing.
Because they just kind of get on with the times type of thing, or what?
It turns out to be an oligopoly.
Yeah.
And then each year it's hit or miss with what new titles you come out with. You build up a back catalog of things. But then each year you have these new things that come out, and you kind of each have an equal chance of getting it. I mean, sometimes Disney does well and Paramount does badly. Or
Sure,
whatever.
yeah.
But basically the top 5 or 6 movie studios, the major movie studios today are the same ones that they were a very long time ago. A lot of book publishing is the same. So those are ones to consider, yeah.
It's interesting. Do you remember one time I asked you in our car, one of our car rides, where we chat about stuff? I said, out of all the businesses that you have analyzed, if you were to start one today, what type of company would you start? Do you remember what you said?
Like an arcade?
Yeah, an arcade.
Yeah.
Why is that? I mean, it just kind of fits, right? The next 30 years or whatever, and you said an arcade.
Yeah. Right. Well, if it's in the right location.
Yeah.
If it's in the right location. Like there's one I've been to on the boardwalk in New Jersey. That's the right location. It's a harder thing for like Dave & Buster's around here where anyone can come in a mall location.
Sure.
But yeah, if you're in a tourist destination type location, yeah, you put very little into it. There's almost no staff involved in it. People just come in and
kind of runs themselves,
spend
right?
the money on it. Yeah, and it's really successful that way. But there are other things like that. I mean, there's tons of businesses that are similar to that. I think we talked to someone who talked about a rock climbing business.
Oh yeah,
as
we
an
did.
exercise business and
Yeah.
how good the economics were of that. And can you believe that? And I kind of thought about it and said, yes, I can totally believe that. A rock climbing gym has amazing economics. But the problem with those, of course, with the gyms, like all the little exercise studios and things that they've opened up, is they do have amazing economics, but like around where I live and stuff, as soon as they open one up, then they open another thing next to it. Like they open a thing that's a spin class, and then next to it they open a surf
cycle
thing,
class,
and then they open a weight thing next to that, and then they open a yoga thing next to that, and so that's the problem. So it has to be some business where it's closed off in some way. So I don't know, a major movie studio would be pretty good. Yeah, I would look into some sort of something that has rights to entertainment.
So this is if you were to hold a stock for the next 30 years? Or are you saying like if you were to start up your own company for the next...
No. If I had to hold it for the next 30 years, yeah. I think I'd want it to be something that's not financial. And if I'm going to own it for 30 years, I really don't want it to use debt,
Sure.
But any of these things can run into problems and conglomerates and things like that. I mean, we talked about Berkshire Hathaway, but look at GE. So,
Sure.
And that would have seemed to be a diversified thing, yeah.
Did you look at that company recently? Since everything's happened to it?
GE?
GE.
Yeah, I did write it up for the website,
yeah.
And I've looked at it, so...
If you want to read that, Focus Compounding.
Yeah, I mean, I wrote it up mostly because I was interested in what if they break up and if there are different parts that might come available,
Crazy. Alrighty. Has the latest news on BWXT changed your thesis at all? It's hard not to get excited reading about the company's projects, but it's difficult to grasp on how serious the weld effects might be for them.
Right. So BWX Technologies is a engineering company, and the most important parts are critical nuclear components. But the issue that they're talking about there is a problem with submarines, nuclear subs. But it's not a part of the critical nuclear components. That's a part that I think's missile tubes. I think that's what they're talking about there. Because they also have a missile tubes business. It is... So here's the thing.
Can I add some context?
Yeah, sure.
Okay, so... The stock was trading around, looks like above $60. I'm guessing this is why he's bringing it up. It's probably back in play. It was trading above $60. Looks like, I'm looking on my phone, maybe like $61. And it fell to a low of $44.13 within the past couple days. So I'm guessing that's why he's probably asking about it, just for people that. And we are recording this on, what's today? The 12th, November 12th? Okay. It's going up next week, so yeah.
All right. And you can go and look at the earnings call transcript where they talk a little bit about it.
Yeah.
So it's an engineering issue. So the first thing you should know is that whatever they say about it, like if they say, well, it's isolated to this one incident and it wasn't actually, not this one incident, but it's isolated to this one project and it's not actually in any subs that we already delivered and things like that, which they may say, expect it to get worse. So always expect to get worse, just like you should always expect cost overruns and things.
Sure.
And engineering stuff the first time they do something. However, this company is BWX Technologies, which is different from Babcock and Wilcox Enterprises. I sold Babcock and Wilcox Enterprises because they had issues that really concerned me about projects they were doing with like waste to energy. I think this is different from that. So I would say for the long term, I would be interested in looking at this company. This is an opportunity to look at BWX Technologies. However, I do want to say that for the shorter term, if we're talking about like within the next quarter and the next year, with an engineering problem, expect it to get worse, expect unpleasant surprises, expect that sort of thing. But if you're looking at this to own for 5 years or something, and you're thinking, well, now it's 40 something instead of 60 something, the stock, is this the time to look at it? And I'd say, yeah, it is the time to look at it. So it's definitely time to learn about the business now. Short term, you always should expect engineering stuff to get worse, but this doesn't sound to me like a problem that would be devastating to the company. Yeah.
Got it. Cool. I like this one. It's kind of, I guess, along the lines of the 30-year question. What do you think about the buy and hold forever strategy?
It's an interesting one.
You want to know my thoughts?
Yeah.
So, I mean, obviously, who says it a lot?
Warren Buffett.
Sir Warren.
Yeah.
And if he was managing a lot of capital, the size of a lot of people that are listening to this podcast are holding today, do you think he would be a buy and hold forever?
No.
Exactly.
He was managing the kind of money they are.
Yeah. Yeah. So, I mean, that saying, I mean, sounds great. I understand, like, the mindset that goes into it, which I completely agree with, right? Concentration and being very selective, et cetera. But I don't think if he was managing 5, 10, 15, 50, even 100 million, he wouldn't sort of employ that mindset. He'd probably have a lot more turnover than he does, obviously.
I don't think it's the optimum way of doing it. No.
Yeah.
However, it's interesting because a large number of people index. And
which is sort of a buy and hold forever, right?
Yeah, except I'm not sure that it is better than buying and holding forever.
Yeah.
So indexing is slightly more complicated. You have slightly higher fees than you would if you bought and hold forever. And yet I'm not sure that you end up getting a different result. People like it because they compare themselves to the index, and the industry does a lot of selling on the idea of this. But it's an interesting question that I've looked at many times of trying to figure out, well, but why is it better to index than it is to buy and hold a group of stocks? Now, because of when people's money flows into their accounts, because of how they're saving and stuff, it makes some sense. But why are you doing the actual process of trying to rebalance and indexing things over time, adding a little bit of cost
Sure.
and all that?
Yeah.
When you could just buy and hold forever. And what would it be if you bought and hold some stocks, some businesses that you liked forever instead of owning an index? Would it be better or worse? So I think buy and hold makes sense as an alternative to indexing. I wouldn't say that makes sense as an alternative to buying and planning to sell in 3 to 5 years or something when you find something better. The reason why we don't buy and hold forever is basically because we find something that's even cheaper.
Sure.
Usually it's a price
It's
thing.
an opportunity thing.
Yeah, it's the thing that you bought. Like I bought BWX Technologies and it rose, well, it more than doubled pretty quickly, and then some other things go down in price, and that's why you sell one and buy the other.
Mm-hmm. I agree. Any follow-up thoughts on KEWL in the face of a lumber downturn and delayed REIT conversion?
Yeah, I don't really care about the REIT conversion.
Yeah.
I mean, we'll see what happens.
I think a lot of the selling pressure has been because the whole board situation, probably like them selling, right?
It might be, yeah. So I like KEWL a lot more now than I did when I first looked at it.
And the reason for that is you were looking at it around $100 per share, and now it's trading about $80
yeah, when
per
we
share.
wrote about it and stuff, it was everywhere from like 98 to 100.
And I think you thought it would be worth anywhere like, what, $115 or something like that in your report?
I wrote about it, yeah.
Something like that. I'm not
it
sure.
might have been. I don't remember the exact appraisal. I know that it was around 100,
Yeah.
and I said that it's very hard to come up with an appraisal less than 100.
Yeah, there you
It's
go.
impossibly hard, it seemed. I think some other people suggested prices as high as like 120 or something, and that's probably very possible. I like it. I like it a lot more now that the board that's in control now is there, and I really liked the letter that they put out and the things that they're saying. As far as the REIT conversion, so there's like the possibility of a REIT conversion, and that was never something that necessarily excited me. It was an issue that the board had talked about. Obviously, they have tax issues, but there should be, I think they'll try to find some way. There's a very large owner who now controls the board.
Yep.
Which is a hedge fund. That they will try to find some way of a tax-efficient way of if they do a sale of the entire company.
They've been in the business for like, what, 7 years, right? A long time.
They might have owned that stock for 10 years.
Yeah.
Yeah.
And they haven't really made money on it.
No.
Yeah, so
good
incentives.
That's Cornwall Capital.
Yeah.
We're talking about, yeah. So, I like it better now because of who's in charge. The decisions that they made recently seemed fine to me, and it just seems like they're looking at their options and stuff. So, because the price is lower and because of the communications we've gotten from the board, I like it a lot better today than I did then. Yeah.
Cool. How do you react to extreme price moves? Do you double up, double down, do nothing, etc.? It depends. Is that what you're thinking?
I guess it depends.
That's what you're thinking.
But I think it depends more on what my portfolio looks like, what other things are in it.
Yep.
Because I will double down if I see it as a big trade up, especially in terms of safety and quality, like really safety. Especially.
What do you mean by that, though?
If I can sell things that I think are stocks that I think are less safe and lower quality to buy something that I think is more safe and higher quality because it's gotten cheaper.
From placing your trades, I could see that.
Mm-hmm. Yeah.
Yeah.
So it often means more concentration because I'm selling my fifth best idea to buy more of my first best idea when that happens. Now, if my fifth best idea dropped a lot in price, I don't think that you'd see a lot of buying of that probably. Because I don't think that usually the reason why something's my fifth favorite idea instead of my first favorite is not price. It's because it's a little less clear what's going to happen. I don't like the management as much.
Sure.
Perhaps not as safe, any of those things. So yeah, in general, when I can trade up, especially on safety, on the certainty of what I think is going to happen, like to own more something with the wider moat. But I'm really looking at a trade-off within my own portfolio. Yeah. And so There have been some big drops that I've seen. I had a stock that went up probably 50% or something, and then went down even more than what I originally bought it at, and I bought more of it.
Mm-hmm.
So I can think of that case.
Did you double down?
Did I double down? Pretty much. Not quite double down, but yeah.
Significant,
yeah.
Cool. Next question. Another BWXT.
Okay.
So it's definitely a interesting play right now. Do you have an opinion on the acceleration of U.S. carrier production? And more importantly, it appears BWXT appears to be trying to diversify their business. Most notably, they acquired Nordion, a major supplier of medical isotopes. Love the show. Thanks.
Okay.
I'd add that.
Yeah, I'm not sure if they're trying to diversify.
Thanks for listening.
Okay. I'm not sure if they're trying to diversify or not. Their expertise is in nuclear stuff, and that's a very small part of the economy, and so there's not a lot that they can buy and stuff like that. It is true that they did diversify, but I don't know that means they want to be less reliant on the business that they have as much as they just don't want to just buy back stock and pay dividends. You know, they want to grow the company and stuff, as most big public companies do. The Nordion thing seems fine. I had some slight familiarity with the company in its previous. It was part of something that had that I had read about and stuff, so I knew a little bit about it. Yeah, and I think I mentioned in a follow up on Bwx Technologies that they were doing a little work for NASA and things like that. So they do all of those things. I think it's a very interesting business, and I think that people should look at it. Most of the things that they do are still very, even the most competitive things that they do are less competitive than what most companies are in. There's less players in it. There's more regulation of it. There's just a lot of risks to it because of how nuclear works.
Mm-hmm.
But I do want to caution that this is not a very cheap stock, even if it's dropped a lot, because it went up a lot.
Yeah.
And after the spinoff, and I bought it before the spinoff. And on top of that, when it does acquisitions and things, they're not at really cheap prices because people know that these are wide mode type things.
Sure.
Yeah.
Another question on another stock that we wrote about, which we were actually going to buy.
Okay.
But we didn't, for the reason that's referenced. Any thought on the Pendrell reverse stock split?
Yeah, that's my only thought, which is that we were going to buy it. And they did a reverse stock split, which
went from like $600 to some crazy amount, right? Was it 600 something in that area?
It was 600 something. And
see where it's trading today.
Okay, and it did a reverse stock split.
Yeah.
So that made it very hard to buy. And because we manage individual accounts and not a fund, it wasn't possible for us to buy.
If I'm looking at the right thing, $169,000 per share.
Yes, that sounds perfectly right. Yeah, it went from I don't know, under $700 or something to $170,000.
It was kind of like low key too, right? Not a lot of people knew about it.
Well, it was a dark stock.
Yeah.
So that is true. Yeah. We were gonna buy it.
Yeah.
I had written it up, and it made sense to buy it because there was a point where we could have bid for it where it was trading below net cash.
Yeah.
And it had some positive cash flow from patents, and it had huge net operating loss carry forwards. And then, they did what they did basically to push out, passive minority shareholders and concentrate, control more themselves probably, and operate in the dark, which we already knew they were doing. So it's kind of a two-step process: stopping registering with the SEC and everything, and then filing with the SEC, and then doing the reverse stock split. So it's sort of a way of them basically going private.
Yeah.
So yeah, we would have bought it if we could have, but that reverse stock split stopped us from being able to.
That's right. Alrighty, next one. What do you think about the current high state of profit margins?
They're likely to revert somewhat.
Yeah.
Yeah, because here's the thing. So profit margins, net profit margins, right? Net profit margins are the result of a company making money, the private sector making money, and then having to share that money in some way.
Sure.
With workers, with lenders, and with the government. So recently you had a corporate tax cut. But the question is that you ask when you think about profit margins is, okay, are workers likely to be paid more in the future relative to the economy? Are lenders likely to collect more interest relative to the economy? And is the government likely to collect more taxes relative to the economy? Now, it turned out that the government is collecting less relative to the economy now. So you had a tax cut. But I would expect that wages relative to corporate profits would go up over time. And I would expect that interest charges relative to corporate profits would go up over time. So you're going to have some reversion for that reason. You have very low inflation, very low wage inflation. And, so it's...
So you think it's going to revert a little bit?
Yeah, we'll see. But those are things that you can think for a really long time.
Yeah.
I mean, we have very, very low unemployment. It's very hard for companies to fill positions. I can think of lots of companies that have have fewer workers than they would like to have, but they're not yet willing to pay them a lot more to fill all those positions. So, there's a certain inertia there. They're used to paying us, $16 an hour. Then if they're only filling 6 of their 10 spots that they want to fill, they're not necessarily going to say, okay, let's start offering 20 right away.
Sure. Yeah. How much time do you spend on quarterly earnings or updating your Excel models, if any?
Yeah, almost none.
Yeah.
I do have a watch list of stocks, so things I don't own that I check regularly. Mm-hmm. And I actually...
just like, what do you mean by that? Like checking the stock price, checking up on like the news, the press releases,
Yes.
earnings, everything?
All that stuff.
Yeah.
So I spend a lot of time not looking at the stocks that I own. I spend a lot of time looking at the stocks that I might research and buy.
Yes.
Yeah. So what I do there is I have an Excel sheet with about 12 stocks in it that are the next 12 stocks that I would research to potentially buy.
So it's your lineup, if you will.
Yes. And I already know the next sort of 2 that I'll research. And then the others below that, it's a question of, how their prices move around and what
in
I
the
learn.
order that you put it in. If
Absolutely.
people want to copy you, it's the ones from top to bottom, the ones that you're most interested in, and
yes.
you go down like that. Yeah.
Yeah,
and that's the way that he structures his portfolio as well. When he was talking earlier, how he may not like his fifth idea as much as the first idea, he always puts out the portfolio 1 to 5 on the company that he likes the best at the moment. So then if he finds something that he likes better than the fifth, well, the fifth gets sold and then the new one gets on.
Yeah, like in the managed accounts right now, I think the 3rd, 4th, and 5th most biggest positions happen to be about the same percentage size. Mm-hmm. But I actually have, I know which I like 3rd best, which I like 4th best, and which I like 5th best. So I do keep track of that. And so I know which stock I would sell first. So that is a good question in that I do follow up with the stocks I own in terms of ordering them. Now, the truth is I don't spend a lot of time, I usually don't spend a lot of time thinking about the stock I like the best. Because that's not the marginal stock. It's not the first one I would sell. It's the last one I would sell.
So where do you start at, 4 or 5?
Yeah. So my least favorite stock is the one I've thought of the most.
Yeah.
The least favorite stock I own is the stock I thought of the most.
Sure.
And my most favorite stock I don't own is the stock I've thought of the most.
Yeah.
If that makes sense.
Yeah, it makes total sense. Yeah.
Because those are the ones that could switch positions.
Yeah.
Basically, I could sell the thing that I own but like the least, and buy the thing that I don't own but like the most. So the things that I don't look at a lot, to be honest, unless there's a possibility of increasing the allocation to them if we're not done buying them or something, if it's still an issue of how concentrated we are or something like that. Except for that, I don't spend a lot of time looking at my very favorite positions. I really don't, because I've liked them the most, and I still like them more than the other things. I look at the problem children in the portfolio, right?
Sure.
I look at the ones that I'm most likely to sell, the ones that I'm most concerned about, and usually that's an issue of like they have the least wide moat, they have the management I like the least, they're not quite as safe. Right now we have a portfolio with no debt in it, but if we had stocks that had debt, they would probably be the stock with debt in it.
And that's when you structure the portfolio the way that we do, where we don't raise cash for the sake of raising cash.
Correct, yeah.
Unless we're going to use that cash to buy something else.
Right.
That's sort of the way that people should go about doing it. I mean, at least obviously that's what we think, because that's what we do.
Yeah, because they're liquid stocks, sell things and then get a cash position, but it's only because I already am planning to buy something else.
But I think when you do that, though, it almost adds a psychological thing that you're not just going to sell because of market movements or whatever. You're purely selling for investing situations or because of the business or because you like a new business.
Yeah. I think I said that before kind of to someone, that I have an ordinal idea of the ordinal values. I have a rank value of everything in my mind.
Yeah.
I don't have a real idea. Like a lot of people have this idea of like, if it hits $45, I'll sell it. I have more, I like it better than stock C,
Yeah,
but
yeah.
less than stock A.
Yeah.
And that, in my mind, is what I'm changing, is that over time, as the stock becomes more expensive or something, it goes from being my favorite stock, my first favorite, down to my third, fourth, fifth, and then eventually it drops off the list.
Sure.
And that's when I sell it.
Yeah. I think that's a good way to go about doing it. We have one more question.
Okay.
It says, does it concern you that the bulk of the rise in the main U.S. indices is due to a few big companies? A lot of companies, and they put in parentheses, I'm referring to the UK, haven't moved much this year despite having some decent updates. Isn't this similar to the dot-com boom/bust?
It's become more similar recently.
Because just stocks have been, like, majority of the gains have come from a few companies, or what?
Yeah. I mean, most of the stocks that I look at, either stocks that I own or would own or something, have not performed that well. They haven't performed that badly, but it's been a long time that they certainly haven't been going up a lot with the market.
Sure.
So you don't have a very wide amount of different, broad amount of different stocks going up, especially
Sure.
The smaller ones and things like that. And it has become, I would say, in just the last couple of years, really, there has been a change where there became so much focus on, we talked a little bit about like FANG stocks,
Sure.
right?
Facebook, Apple, Netflix, Google,
Right.
Amazon.
Yeah. And Bitcoin,
Sure.
marijuana stocks, and I've also seen it with like Tesla.
Where's Bitcoin trading today? I'm just
So-
curious. 6,315.
So I just mean the amount of
Yeah,
attention that
sure.
goes into those
Yeah,
sorts
absolutely.
of things, and so little
The
attention
craze.
paid on valuations
Yeah.
and things like that. So that is similar to the .com, and that isn't what I saw until the last few years. So this is a bull market that's been going on a really long time, and although the overall market got slowly more and more expensive, we didn't see it sort of these pockets of obsession by the market and by news and by people on the internet and everything about just a few sorts of stories. And now we do see more of that. I would say that's true. That there's a real focus on some sorts of things, which is good if you're a stock picker. It's not bad.
Sure.
So you were saying, are you concerned? No, I actually did well in the .com bust. The .com bust, first of all, in terms of relative performance, by far the best I've ever done is the bust of the .com and the following recession.
Was that because you weren't invested in .com names? So it was like more traditional value
They were
oriented?
completely unaffected.
Yeah.
I was invested in things like a local grocery thing.
So when like all those .com stocks were getting smoked, were those companies getting crushed as well, or did
No.
sort of the rotation happen where value
No, they
came
didn't
in?
get crushed
Yeah.
at all. I mean, honestly, in this bull market, I have not done better than in this bull market, I have not done better than I did during the .com bust. I did just as well during the .com bust as I've done in the year since then. Now, the market's done much better from 2008 to today than it did in 2000, 2001, 2002, right?
Sure.
But those years, I did just as well as I've done recently. There was no effect to it. But like 1999 was tough. Which is when I was starting investing around then. That was really tough. You underperformed. Things that you owned that were boring and cheap got even cheaper for no reason. And
Is that kind of like a lot what we're seeing today?
yeah, so it hadn't been until really recently, and now it is becoming that way. Because it becomes that way in things like, for instance, when you talk to someone, like they'll say, this is a little bit more closer to the .com, which is that I will now talk to someone and they'll want to talk about Tesla.
Sure.
But they won't want to talk about General Motors.
Yeah.
So they basically don't know what General Motors is priced at. They haven't valued it. They haven't done whatever, but they really want to work on looking at Tesla. That's what happened in the .com era, which is that it wasn't just I like this kind of company better than that kind of company. It was I'm only interested in the internet type company.
Sure.
The old economy companies I'm not interested in at all. And so now
That's what you saw what happened in Bitcoin, though. I mean, not even a year ago. No one was. They were just all interested in Bitcoin.
right, yeah. And so that's interesting, and it is similar to what happened in the .com era.
It was interesting to me was you saw it ran up to like what was it 25,000 ish or somewhere in that. I don't know, a lot. And then liquidity started to come. Right? Didn't they offer Bitcoin futures? So I felt like all the pros, all the people that had all these gains, we're just going to start selling to the suckers, right? And I mean that in the nicest way. But that's typically what happens.
Yeah.
When Grandma Lily, shout out to you if you're listening, asks me about Bitcoin, who knows nothing about it. You know, it's crazy. It's kind of like 2008, right? When all the big banks knew everything was happening, and when they started deleverage, or like getting the risk off their balance sheet and just giving it to the individuals.
Yeah, and Bitcoin and some of the things like that fall into the category of some of the stuff that happened, the .com thing, which is that there were some companies which are around today and are some of the biggest businesses around that were around then. But there were also things that had no, that were not real businesses and that really shouldn't have been sold to the public and everything. And it was just, and there's a little bit of that now. And especially, I mean, I manage the managed accounts and stuff, do a lot of stuff with over the counter stocks, right?
Yeah.
Well, you can imagine what over the counter stocks are really liquid and get all the attention and everything. They're not the stocks that I buy.
Yeah.
But I mean, I spent a lot of time on that website looking up the different stocks and everything. And, it is a lot of marijuana stocks and things like that. It's a lot of very different sorts of things than what is the sorts of stocks that we look at. It's a lot of stories, a lot of things that build into bigger trends.
But do you think that the marijuana industry has probably a more promising future than, other sort of what could be classified as boom and bust type of, industries?
Well, the difficult thing is the business model of how they make money.
Sure.
Right? So I don't disagree that the future of marijuana is bright, but about particular companies, yeah, I do. Because it has to be that, how is this company going to make a lot of money? How is this one going to be the one that's dominant in this space?
Somebody asked me, they're like, do you guys have marijuana stocks on your website? And I was like, no, we don't. And he was like, I'm just actually kidding. I completely blew over my head. I had no idea.
Oh, okay.
He was just messing around.
Yeah. So, I mean,
what about the recent volatility in the market? Do you think anything of that? I mean, when you talk about like this cycle, I guess you could say, right? You were just talking about how it reminds you a lot like, the tech boom or .com, whatever you want to call it.
Yeah, it reminds me a lot of it.
Does this recent volatility that we've experienced in the market sort of pique your interest at all, or does it even go into your thought process?
Yeah, I like the volatility a lot. I mean,
because you're a stock picker.
Yeah, I think we talked about this in a very, very early podcast. We did a podcast on volatility in the markets or something like that.
Yeah,
because it was the first day of that year that there had been a big drop in the market. And I like it because it changes the price of the stocks that I might sell and buy. Well, the most frustrating thing is when you have consistently higher moving prices at very, very slow intervals of increases. When the market's going up 1% a day pretty consistently. Yeah. That's the worst thing for a stock picker because there's very little volatility. You can't sell one thing that's getting more expensive to buy something that's cheaper. And yet everything's getting more expensive and more, the things are sort of falling off your list of things you'd like to research. So no, I like it a lot when there's a lot of volatility there. Although, like that question was about the sort of leading stocks are very different from the sorts of things we own. So there doesn't seem to be much of a relationship between if the market drops a lot or something because of FANG type stocks. Yeah, that really is very different from what might be happening in our portfolio that day. And so it is a big disconnect from those two. So sometimes it's not like the stocks that I might buy are actually getting that much cheaper. But the .com thing was a great time to be a value investor. Great time. When it
actually cracked.
And
sure.
Yeah, because then you don't own those sorts of things. Yeah. So I mean, it was like I said, I had the things I owned at that time were video game stocks, food stocks, a supermarket, just the most boring things that you could imagine. Yeah, and not the leading in any of the cases that I can think of, not the leading one. That was the other thing that really happened then, is that all the focus was just on the leader. And I don't know that you've seen that now. Like I guess we mentioned Costco for a moment before. It's not like Costco stock is really cheap and Amazon is incredibly expensive. That's the sort of thing that you would see in the .com era, is that you would have that two companies that look similar in a lot of ways, and yet one of them, because it's internet stuff, is at an insane valuation, and the other one's really cheap. And the part that I'm not seeing is the other one's really cheap. That's unfortunately the part that I'm not seeing. There was just a very wide gap. It wasn't just that the market was super expensive in the .com period. It was that there were actually some really good bargains. Some of the best bargains that I've seen actually were during the boom years, the end of the boom years of the .com, which is so unusual and interesting, that you had a great economy, a really strong performing stock market and everything, and yet I could find cheap, boring companies that just were predictable and stuff at really nice PE ratios. And I don't see that part of it today. Yeah.
Cool. We actually have another question that just came in that I think is good to go over. It says, many value investors are shameless cloners. You're quite transparent with your investments. Now that you have managed accounts, do you see a problem with people who are tailcoat investing with you if they don't have a minimum of $100K to put in your account or for any other reason? ?
That's a good question.
Great question.
Yeah. I guess we should say that one reason that we have a minimum is actually that concern, I guess, if that makes sense to people. Because they're managed accounts, they're not fun. People can see what we own, what we're the moment we start buying something or selling something. If they're a client, and there was some concern with that, because some people said, well, "I'm going to put in a really small part of my money with you, and then I'm going to manage money separately for myself." And that does become a bit of a thing. Like, well, are they, is it about ideas rather than about us managing their money? Yeah, it's a really good question. I guess I have a different opinion about ideas than some people do that way. I mean, we talk about ideas on this podcast. I write about them and stuff. I don't think that saying the name, saying cool or something, means that will.
Yeah, I mean, maybe they think we're talking about like COOL, right?
Yeah, COOL. I'm just kidding. So the ticker on that one's KEWL.
Yes.
I don't think I look at a lot of different stocks and I pass on so many of them.
Well, here's the thing, right? We talked about KLXI Energy Services for so long.
I don't know.
Probably a lot of people probably thought we were going to buy it.
Yeah,
and we didn't buy it. We talked a lot about it, and it definitely looked interesting. We could say that.
Yeah,
but we didn't buy it.
As of this recording, we do not own KLXI.
Yes, people probably thought we did.
That's true. No, people think that I own a lot of stocks I don't own, and I get emails a lot that say, "I know that you own this stock," and I actually didn't own it. I just wrote about it a lot, and I never said that I owned it.
Yeah,
I didn't think I gave any indication that I owned it, but. Also, you have to remember that a lot of people reading things are reading things only for people who own the stock.
Yeah.
Because especially people who own 30 or 50 stocks or something, or who are trading frequently. Yeah, I don't know. It's something that I talk about a lot, the ideas. I think it helps investing to talk through the ideas with someone, to write them up. And I usually, it depends. I've had some ideas that I buy pretty quickly. And so I guess... someone could coattail ride on that. I have to say, I don't think I invest in ideas with catalysts. I mean, like if you were going to coattail ride on something, you should read Clark Street Value blog or something.
Yeah, it's more of like a
special situations. Yeah, that is written up much closer to the time.
Yeah.
That it happens, and then is I think sold more quickly.
Yeah.
So I saw that with like NACO. A lot of value investors seem to buy NACO and Hamilton Beach Brands. Buy NACO before the spinoff, but buy NACO and Hamilton Beach Brands for the spinoff, then sell it a few weeks later, and then over the next year, those stocks came down a lot when I thought the business performance was fine.
Yeah.
And then the stocks came back up, and I think that is typical of how a lot of value investors think, which is that those spinoffs and things are situations to be played for that game, which is fine because if you can time it right and you get a 50% gain or something, or a 30% gain in a matter of months, that's amazing.
Sure.
But yeah, I think a lot of people are in it very short term on those sorts of things. So I think about ideas with catalysts and things like that. It's interesting. I mean, I read Value Investors Club, and like I've said before, I'm not sure I've ever gotten an idea from it. I read a lot of blogs, and it's hard to say what ones I've found an idea that I like from that and buy. I did say that I got NACO from,
I was going to say, didn't you say NACO?
Clark Street Value. Yeah, although I didn't know the company already, but that particular post really drew my attention to be the next on top of my research list.
But does it worry you, though, about people riding our coattails? I mean, we don't really post our ideas.
So far, it hasn't worried me.
Yeah.
I should say. So far, it hasn't worried me, in large part because I don't think there's much coattail riding going on, and certainly not for the long term. What little coattail riding I'm aware of seems to they get bored too fast and don't keep doing it. But I have talked to a few people who, because I wrote reports on something or because I talked about something, did buy it and hold it for a long time. So there are some times where they did that. Although mostly that's like what they're saying really is you drew my attention to it, so then I researched it. And that's true that you are causing discovery of it that way. Yeah. I mean, it's a potential issue in some very, very small stocks. It's something that we've thought about before. It's a larger issue, I think, with just the illiquidity of it and things like that.
Sure, yeah.
And having to be careful about that. And I think it's mostly
It's not like
more of
they're
an
front
issue
running
with-
us. I mean, I
No.
guess there's a difference between front running and coattail riding.
Yeah. I mean, yes, there is a difference. They can't front run because if people are following you, they can't front run you.
Yeah.
But I mean, does it cause a problem in that? I guess the two things. One is is it causing a problem that do you feel like you're giving away something for free to people, an idea? Mm-hmm. And yeah, I guess you feel like you're giving something away for free that way. But I mean, we're doing a free podcast. We write up things on the website. We have a paid member site. You try to give value to people.
Sure.
Yeah. I think that the performance people get in the managed accounts would be different than what they would get if they were just a member of the site. And I think that the ideas you would get from reading the site are a lot different from what you get from this podcast. Mm-hmm. But yeah, we do talk about things on the podcast and on the member site too. And also the other thing is not to get too inside baseball about all these things, but the truth is, it's not the number of people who hear about something. In cases where I know that someone did some coattail riding, it was just that they were managing a fairly substantial amount of money.
Sure.
That it had any effect on anything. And actually, that's not from our managed accounts. That's just other times that I wrote on sites that had... I sometimes wrote some articles that got sort of widespread for whatever reason, a lot of page views or something. And in some cases, I know some people talk to me about it. And... if they manage a pretty substantial amount of money, even if they didn't put a lot of their portfolio into it,
moves it.
Yeah, if they're a big portfolio manager, they can move some things. Yeah, I did have a thing where I did wrote up net nets for a site at one time, and Nate talked a little bit about the same idea that he didn't like. That one problem was that even when he wrote something up and said this is not good, it would spike.
Yeah,
and I had that. And
is that just you think algorithms? Picking up keywords and stuff, or do you think people when you literally would say do not buy this, and because it's so thinly traded, or what do you think?
It would just draw attention to it. So it was something that had so little attention paid to it that suddenly when there was attention paid to it. I mean, the reason why something's illiquid is because there's very little attention paid to it. It's not just it has to be illiquid for a reason about how much people are investing in it.
Yeah,
and stuff.
sure.
And that's usually why is that there's so little attention paid to it. So that was the least pleasant part of writing about things was when I was writing a net thing, because people would read it. The people wouldn't even really read the report and stuff. They would just act on it to try to buy this thing because of the idea of net is a formulaic thing. The stock's not well known. It would cause the biggest move in the stock that had ever happened before.
Which only attracts more people.
Yeah,
come in.
and then it attracts momentum
traders,
type things. And people are saying, why is it moving and stuff.
Sure.
I did not like doing that.
Pumping it.
Yeah, and that was the thing where I had to pick from a list of net nets when I was writing for that site. Because it had to qualify as a net. Mm-hmm. So all I was trying to do is pick the least bad, whatever, the thing I was most okay with and could say the most about.
Sure.
That was on a list of net nets. But just talking about, they're just not talked about that much and stuff. So when you talk about something like that, it does draw attention to it. Sure. I don't, in general, I'm not as worried about coattail riding things as most people are, I guess. What do you think?
I would agree. Like I said, it's not like they're front. I mean, it depends how you look at it, right? If we're bringing, if we're bringing attention to this idea that we have that not a lot of people are looking at, in a way, I guess that could only help us out if we're being honest about it. But I understand. Sure, I understand other people potentially getting stuff for free.
That's what they're thinking about, is that they're getting it for free.
But you could look at it. I mean, you said yourself, right? I mean, Clark Street Value is a free website, but you got an idea from there, so I guess it all works out, right?
Any ideas that I've gotten, the best ideas I've gotten have been free.
Mm-hmm.
So, and even when that's the other thing that I should say though, even for the website Focus Compounding and for my write-ups and stuff, when I did reports on a stock, I always tried to make it that the fact I was saying a stock's name was the least important part of what I was doing.
Yeah.
And that it would be useful to read the report beyond that, and then it would have a timeless quality to it that way, especially.
Why do investors put out their presentations at the Irish Zone or on the internet? Why? It's because they want to,
and we
bring exposure to it.
Yeah,
but I understand the whole getting it for free, but I don't know. If people want to thank us, you know what they can do? They can rate and review our podcast.
Can rate and review our podcast.
Because that will make Jeffrey so happy.
Mm-hmm.
And me too.
So rate and review our podcast, review it, say that you get free ideas on this podcast.
That would be great.
Yeah.
Help spread the word.
Yeah.
Helps keep
and
the lights
subscribe.
on. And subscribe.
Rate, review, and subscribe. And
That's
Apple
right.
Podcast is called?
Yeah. And we are trying to get on Spotify as well.
Because we get people from Android talking to us.
That's right.
Yeah.
And you can also subscribe to our email list, and that will put you on Jeffrey's memo list where he writes an investing memo. And we have a few different things planned for the website that we're not going to be talking about, but maybe get on that list, and we'll give an update to everybody here shortly.
Yeah, getting on that list. We aren't going to say what we're going to do, but getting on that list would benefit you.
Yes.
So if you just give us your email by going to focuscompounding.com, putting your email in that box that says to join the memo list, that will definitely help you in terms of future content.
Yes.
Yeah.
Should I see if we have any more questions that came through here on the
Okay.
Twitter sphere? Doesn't look like it.
Okay.
Doesn't look like it. So, thank you so much to everybody that asked. That was probably the best Q&A that we had. I mean, a lot of good questions
We got a
came
lot
from
of
people.
great questions here.
And if you want to, we're going to do this probably, I think we should make a point to do it at least once a month as our, listenership grows. I think it's really good to do.
Yeah.
So if you want to be on the lookout for that, follow us at Focused Compound, and I'll tweet a call for questions, and everyone that asks a question, we answered. So I mean,
Okay.
we'll answer literally every single question that comes through because I think it's a lot of fun.
All
So
right.
other than that, thank you to everybody so much for listening. We will see you next Wednesday. Any closing remarks?
Nope, that's it.
That's it. Alrighty. Have a great week. We'll see you next Wednesday. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.